Coming up on Business Incorporated today. South Africa's coal exports increased by over 700%. And Nigeria's Naira rebounds to 720 to the dollar in the parallel markets. Uganda and South Korea partner to boost education. Hello and welcome to the program. I'm Willie Bung. First things first, let's check in on the markets. We're starting with Africa, where sentiments were positive at intraday. Nigeria's NGX rose slightly by 0.10%, while South Africa index jumped by a massive 3.29%. Meanwhile, Egypt's exchange was closed on Thursday for the week with its index in negative territory, while Kenya closed Thursday's session in the green. Now move over to the Middle East, where most indexes were closed on Thursday, except in the UAE, that's the United Arab Emirates. The Abu Dhabi and Dubai indexes were trading positive at intraday. Both indexes were up 0.1% and 0.7% each, while Saudi Arabia and the Qatari indexes closed on Thursday in negative territory. Now, inflation in the U.S. eased last month. We saw the numbers yesterday, with prices showing their lowest annual increase since January. The data released by the U.S. government has been spurring hopes that the Fed might scale down the size of its future rate hikes. But over in Europe, the picture seems to look different, with an official hinting that the European Central Bank, that's the ECB, must and will do more to fight inflation. Here's DW's Chris Kober with more from Berlin. Chris, how do concerns about choking off the economy factor in these plans of the ECB?
They do factor in, but having to choose between economic growth and price stability, the European Central Bank, per its mandate, has to choose the latter, meaning getting inflation to come down is the more important task, even if that comes to the detriment of economic growth. ECB Director Isabel Schnabel made sure of that when she said yesterday that she and several of her colleagues at the top leadership level feel that the ECB needs to increase interest rates in the 19-country Eurozone to slow down the economy into restrictive territory, as Ms. Schnabel put it. Now, the European Central Bank raised interest rates twice in recent months, both times by 0.75 of a percentage point, pushing its key lending rate to 2%. Ms. Schnabel also said that the risk of a recession has grown, although she expects such a downturn to be a mild one, similar to many other economic experts. A milder recession won't be enough to bring inflation down, the ECB director says. A deep recession so far is unlikely, as labor markets appear to be robust, savings have increased in the past, and countries are deploying massive fiscal support currently. Core inflation, which means the development excluding volatile energy and food prices, is pointing towards a prolonged price increase, which the ECB needed to address, she said, even if it pushed the Eurozone into recession. Now, Eurozone inflation stood at 10.7% last month, which is more than 5 times the ECB's target.
I know the ECB's target is to reach 2%, and 10% is a far reach. Now, but other than further raising interest rates, what else is the ECB planning?
Year should see the beginning of quantitative tightening, which means that the European Central Bank needed to decrease the gigantic amounts of bonds it has been taken up in recent years through massive bond purchasing programs. The bank's balance sheet has swollen up to 9 trillion euros. And so far, maturing bonds in the emergency buying program the ECB set up during the pandemic are being replaced by fresh ones, pushing yields. Now, the head of the German Bundesbank has pulled this practice into question when on the other hand, the ECB is raising interest rates, he says. Also, officials of the central bank are quite concerned with the large aid packages many European countries have brought underway in response to the economic woes Russia's war in Ukraine has been causing. This support is increasingly turning into an inflationary factor. The head of Slovakia's central bank says the steps currently undertaken are far away from the temporary and targeted intervention the ECB would like to see, he said. And the current fiscal behavior of governments could quickly become a risk to the attempts to lower inflation.
Now, today is the last trading day of the week. How are financial markets faring so far?
Stocks are largely feeling the tailwind provided by yesterday's inflation figures in the United States. The DAX yesterday climbed 3.5% on the news that price increases in the US are still high, but moderated last month. Now, with Germany's blue chips index DAX trading above 14,000 points, there is the risk of profit taking. Some analysts are warning so far. German stocks continue to rise, though. The DAX is up around 0.5% in the early parts of today's trading session.
Thanks so much, Chris. It's something we definitely keep an eye on, especially on the inflation rate. Thanks so much, Chris Kober from Germany. Now we'll move over to Asia, where Hong Kong stocks jumped more than 7% as Chinese state media reported COVID measures for travel will be eased. Shares in the Asia Pacific also rose after the release of the U.S. inflation data in October. It raised investors' hopes that the inflation has peaked. The Hang Seng Index climbed 7.74%, and the Hang Seng Tech Index surged 10% in the final hour of trade. In mainland China, we saw the Shenzhen component added 1.3%, while the Shanghai Index added 1.69%. The Nikkei 225 in Japan closed at 2.98%. We saw the Kospi Index in South Korea 3.37% up, and the Australia Index, the ASX 200, was up 2.79%. Those are the numbers for today, and we say a rise shows positive sentiment since the U.S. Inflation numbers came out yesterday. Now, stock futures rose early on Friday after China said it would ease some COVID measures in the U.S., building optimism from better-than-feared inflation data that fueled a broad market rally on Thursday. Futures tied to the Dow Jones Industrial Average added 0.37%. We saw the S&P 500 futures up 0.38%, and the NASDAQ 100 futures rose 0.5%. Meanwhile, let's take a quick listen to yesterday's market close with our correspondent, Maria Bird.
The U.S. stock market had its largest gain since 2020 on Thursday, as the Dow Jones was up by 3.69%, the S&P 500 up by 5.54%, and the heavy tech NASDAQ was up by 7.35%. It is clear that investors are very excited to hear about the inflation stabilizing in the U.S. This is also leading to the fact their expectation of the Federal Reserve will slow down on the rate of interest rate hikes. This is a great news for the U.S. stock market, and it is hope for the end of the year.
Thanks, Maria. Now, oil prices jumped more than 2% early on Friday after health authorities in China, the top global crude importer, eased some of the country's heavy COVID curbs. Now, Brent crude futures rose 2.6% to $96.06 a barrel, extending a 1.1% rise in the previous session. You saw U.S. West Texas Intermediate WTI crude futures gained 2.6% to $88.71 a barrel after climbing 0.8% in the previous session. Analysts say the move towards liberalizing the COVID-0 policy will provide a springboard for oil markets, and given that the lockdowns hurt mobility and oil prices more than economic activity. Prices also picked up on Friday after milder than expected U.S. inflation data reinforced hopes that the Federal Reserve would slow down rate increases, boosting chances of a soft landing for the world's biggest economy. Now, gold prices in the metal space eased early on Friday, but were set for their biggest weekly gain in more than 8 months, as U.S. data pointing to slowing inflation boosted hopes that the Federal Reserve would slow its aggressive rate hikes. Spot gold was down 0.2%. Prices have risen 4.2% so far in the week. The dollar index steadied after Thursday's fall, but was headed for its biggest weekly drop since March 2020. U.S. consumer prices rose less than expected in October, indicating that inflation was slowing, which raised hopes that the Fed will begin scaling back its hefty rate hikes. Now, International Organization of Migration back in Africa, in Egypt, specifically, has found a way to improve the livelihoods of migrants in Egypt while keeping the process green. Rooftop farming is creating an income for them using neglected spaces and a green farming technique known as hydroponics. Let's take a listen.
Building in Egypt's Giza, several Syrian migrants plant lettuce to sell in supermarkets, creating income for their families and making buildings greener. The rooftop farming is part of a project to support migrants funded by the International Organization of Migration in collaboration with Shadoof, a local smart farming company in Egypt. According to Shadoof, farming units have been installed on 19 rooftops so far and are now operated by migrants as well as Egyptian families to help them transform neglected spaces into an eco-friendly business.
عندنا مشروع دلوقتي مع منظمة الهجرة الدولية.
That feeling when I'm planting what starts with a seed until it becomes a lettuce, I feel it's like one of my children because it teaches me patience.
Guaranteeing food security for the migrants, particularly relevant now.
The project is also helping to facilitate the migrants' integration in the community.
The first and foremost, most important part is actually the income generating activity, where they have an opportunity to produce something and get some income for themselves. At the same time, it can serve a little bit on the mental health of all the beneficiaries, given that some of the migrant beneficiaries have been through harsh or difficult times, especially in the community. This serves as an incentive to moving forward. At the same time, bringing the host community and the migrants living in the area, bringing them together, collaborating, and sharing information between each other.
IOM project manager Ray Sulo adds that plantal health of migrants who have been through harsh times.
That feeling when I'm planting what starts with a seed until it becomes a lettuce, I feel it's like one of my children because it teaches me patience.
Recipients of the rooftop installations were provided with 2 weeks of training to learn to operate the hydroponic system.
We intend to scale it up. Then by scaling up, we would like actually to work with the Ministry of Education, for example, and do this rooftop farming on top of schools. The idea is to bring children to understand the principle of farming, the principle of hydroponic farming, the principle of green economy during their curriculum. So in that sense, we want to expand the process with the Ministry of Education. Similarly, we want to involve the Ministry of Agriculture, that we can scale it up in the entire country.
COP27, which is being held in Egypt, kicked off on November 6th as the country is implementing sustainable alternatives across industries. Now, rooftops in Egypt, which, according to one migrant, were for clutter, are becoming appealing to the eye.
Now, more stories from the African continent next. This is Business Incorporated. Welcome back. Thousands of public servants began a one-day strike in South Africa on Thursday over wage demands. Professional organizations said the strike is led by one of South Africa's largest public service unions, the Public Servants Association, that's PSA, which has about 235,000 members. The dispute over public servant salaries intensified after Labour Ministry last week announced a 3% increase in salaries, and that's lower than the 6.5% the unions were asking for. For more insights and details on this analysis, practice leader Sub-Saharan Africa Frontier View Matt Kindiger joins me to discuss this. Hi, Matt. How are you doing today?
Hi, I'm good, thanks. Thanks for having me on the show today.
And now, do you expect, Matt, that the government is going to make concessions to end this strike that started? I do know they didn't strike today because of the weather, but what do you think the government's going to do?
Well, so first of all, I would expect there to be further strike action, probably by public sector workers in South Africa because of the wage offer. And in short, yes, I would expect the government to make concessions to raise the wage offer for public sector workers in South Africa. And this is for a number of reasons. The first is that, in our view, the 3% initially offered was probably an opening gambit by the government in an attempt to, pitch its initial offer very low in anticipation of quite tough negotiations with public sector trade unions. So certainly, we think it's come in very low at the start, and it's probably going to work its way up through a process of negotiation. The other couple of things include the government has actually severely restricted public sector hiring over the last couple of years. And this means that because the number of civil servants in total is not growing as quickly, it does have some fiscal scope to raise the amount it pays these civil servants. So there is a bit of wiggle room there. And additionally, we would expect the government to try to keep the trade unions on its side politically. Trade unions, especially public sector trade unions, wield a lot of political influence and power in South Africa, and the government would be very we expect it to be very careful to keep them on their side ahead of the 2024 general election. So certainly we expect there to be some back and forth, but there will most likely be some increase in civil service wages offered by the government.
Okay, but we do know that the government recently presented a midterm budget. But what does this strike, what does this say about the state of public finances in South Africa?
Yeah, so there are a couple of things we can take away from the strike in terms of the impact or what it tells us about public finances in South Africa. The first is that the fact that the government offered a very low initial wage increase, only 3%, does suggest that this is quite unprecedented, especially compared to recent wage increases over the last decade or so. And this shows that the government is facing fiscal pressure to cut spending and reduce the deficit. We must remember that the government has a fairly tight deadline to achieve a primary budget surplus, so that's its budget budget balance before interest payments by the middle of this decade. So it really is under quite a lot of pressure to cut civil service wages. However, what we have seen in South Africa over the last year or so is quite strong revenues from commodity exports, mining production, financial services as well. So the fact that we do expect to see some concessions made by the government does reflect that it does have a little bit of extra wiggle room from the perspective of redirecting some revenues towards civil service wages. But I would say the strike is not unprecedented, but it does reflect some additional pressure that the government is facing to cut its budget deficit over the next couple of years to maintain fiscal credibility amongst investors in particular.
So speaking of tight public finances, how will this affect South Africa's growth outlook over the coming years, Matt?
Yeah, so it's quite interesting because the government is probably going to increase spending and investment below inflation over the next couple of years. We're probably going to see real terms cuts in government spending and investments through 2023, 2024, maybe 2025. And this will take quite a significant driver of growth out of the economy, especially, again, from a civil service wage perspective. Very strong civil service wage increases have been a major driver of consumer spending in South Africa over the last 10 to 15 years, and this is going to slow quite considerably. So we are going to see a sort of weaker sentiment amongst middle-income households, and this will affect the retail industry, for example. We are also going to see a bit of a slowdown in investment by state-owned enterprises and in infrastructure, although the government wants to prioritize investment into road and rail infrastructure and also improving the performance of Eskom. The government will not have as many resources or be able to spend as much as it would like. So certainly from a government spending and an investment perspective, we do expect there to be a bit of a negative impact on growth. But that said, the fact that the government is taking its fiscal deficit and its debt very seriously, and it wants to balance its books by the next couple of years, does mean that investors will view South Africa more favorably and view it as a little bit less risky. So this does support private sector investor sentiment towards the country to an extent. So a bit of a mixed picture, but on balance, we would say that muted public finances not great for the growth outlook.
I know, Matt, you'll be tracking that. Your organization will be doing that front. We'll be keeping that in check and also keeping us updated. Thanks, Matt Kindiga, Practice Leader, Sub-Saharan Africa Frontier View, for joining us on the program.
Thanks very much.
And now, still in South Africa, the Minister of Mineral Resources and Energy, Gwede Mantashe, says the country's coal exports have increased by over 700% since the geopolitical conflict between Russia and Ukraine, and warned that a move from coal-powered energy generation to renewable energy does not guarantee baseload stability. He was speaking in Parliament on a debate on the just transition. The minister was emphatic that any suggestion that coal has reached its sell-by date is a myth, given the work done by the Council for Geoscience in collaboration with the World Bank on carbon capture, utilization and storage, which gave hope and belief that coal will continue to play a critical part in our just energy transition. South Africa recently signed loan agreements worth 10.7 billion rand to assist in its efforts to move away from coal and increase its reliance on cleaner energy. Now in Nigeria, the Naira has recently rebounded today by 20.8% to 720 to a dollar at the parallel market. The development comes 2 weeks after the local currency came under severe pressure at the black markets following the announcement by the Central Bank of Nigeria to redesign the Naira. The Naira, which fell consistently throughout last week against the dollar, tumbled to an all-time low of 910 against the dollar last weekend. However, the currency began a rebound against the greenback on Monday after a week-long clampdown on foreign exchange dealers in Abuja, Lagos, Kano, and other major cities by the Economic and Financial Crimes Commission. Now, Uganda's National Curriculum Development Center, NCDC, has partnered with the South Korean government to carry out comparative studies in schools. This curriculum specialist for history and political science at NCDC, Mr. Said Twine, who is coordinating the 5-year program, says their target is to influence socio-economic transformation in Uganda. He adds that the South Korean school clubs will help to make comparison studies between development strategies in the two countries. And that's it on Business Incorporated. Do join us next week for another edition. I'm Will Ibang. Thanks for watching.